Hello guys, and welcome back to the channel. This is Money Talks with Hamza, and today I want to talk to you guys about how to get started with investing. As a qualified chartered accountant, I constantly get asked about this. I get asked, how do I even get started with investing? How can I go about buying stocks and shares? What do I actually need to do? And to be fair, I can't blame the average person out there for not knowing this, right? Because in the schooling system, at the university even, we don't necessarily get taught this is how you invest, this is how you trade, this is how you open an ISA, stocks and shares ISA. You have to go to a broker to actually be able to buy and invest in and sell shares. So today we're going to get into all of that. How do you actually get started with investing, and what are the practical things that you can do today if you've got a bit of spare money, spare cash, some savings that you want to start investing? Okay, so let's get into it. Firstly, the concept that I always like to stress to people is you have to make your money work for you. It is not enough to just have cash sitting in the bank. If you have cash sitting in the bank and you're not investing it, you haven't got it invested in stocks or shares or index funds or ETFs, electronically traded funds, and we'll get into all of this, your cash is just sitting in the bank and it's losing value over time. It's losing value because of inflation, it's losing value because of maybe the currency devaluation that may be happening, depending on if you're holding your cash in dollars or pounds or euros or different currencies. So there's lots of reasons why holding your savings in cash is actually quite a bad idea. Okay. Secondly, over time, your purchasing power reduces or falls. So what £100 would have bought you in 2008, it doesn't buy you today. What $100 would have bought you in 2008, it doesn't buy that today. So for all of those reasons, you want to think about not just, and it's great, right? It's good to have some savings put to a side, but you want to start investing that as soon as possible. So money loses value over time. That's called the time value of money. Quite a really important concept to get familiar with. So because of the time value of money, money loses value over time. Currency devaluation happens. Inflation will eat away at your savings. Secondly, compounding, the power of compounding is something you're missing out on if you have your savings just sitting in the bank as cash. So what is compounding? So compounding basically means that if you invest your money, and whether you have it in a savings account and it's earning interest, or whether you have it in the stock market and the value of those shares are going up over time, that will compound over time, so actually you will get the benefit of growth. Whereas money that's just sat in the bank clearly won't be growing, so you're losing that benefit of compounding over time. So you could grow £1,000 over the next 5, 10, 20, 30 years to actually quite a sizable amount, because the stock market tends to grow over time. And whether you're particularly if you're investing in index funds, maybe in the S&P or the Nasdaq or even the UK FTSE 100, it typically tends to grow over time. So the American stock market is obviously the biggest stock market, and that tends to grow between 7 and 10% in a good year. So you would be foregoing that compound growth every year. And then if you think about your savings time horizon, could be 2 years, could be 5 years, could be 10 years, it could be 30 years, you will be losing out on that annual growth in your savings. So how can you practically get started today? So I'm going to assume you are a person who is employed, who is in a salaried role, who gets a paycheck every month, who manages their income and costs or expenses effectively, and is able to save a bit of money every month. So you've got some savings that you want to start investing. What practical things can you do today? Number one, it's really important that you have a clear objective in mind, because that will keep you motivated, it will keep you going, it will keep you disciplined to control your spending. So you need to have a really clear idea: why am I saving, why am I investing, what objectives do I have in mind? And maybe set out some short-term objectives, some medium objectives, some long-term objectives. And your investing and savings objectives should be really clear and really specific, right? I'm sure you've all heard of SMART objectives. SMART is an acronym that stands for specific, measurable, achievable, realistic, timely. So the difference between a SMART objective and a non-SMART objective might be: I want to save money for the long term. That's a really vague objective. You're not clear what the time horizon is. You're not clear on how much you want to save. You're not clear on what milestones you want to hit. How much do you want to save by the end of this year, next year, the year thereafter? Whereas a SMART objective might say, I want to save £5,000 in the next 24 months, so that in 2 years' time I've got £5,000 to go out and buy a second-hand car. So you've got really clear value, you've got really clear timeline, you've got a really clear objective or purpose why you are saving in the first place. So you've done your objective setting, and that's quite a short-term objective. Think about your medium and longer term objectives as well. Where do you financially want to be in 3 years' time, in 5 years' time, in 7 years' time, in 20 or 30 years' time? And that should then influence the decisions you make about your investments. So you should typically have some short-term investment objectives, some medium-term investment objectives, and some longer-term investment objectives. In the short term, your objectives should involve having an emergency fund, for example. And typically you should be able to cover between 6 to 9 months, maybe even up to 1 year of your day-to-day living expenses. So that if anything happens, should you lose your job, should you be made redundant, should you fall, God forbid, should you fall sick or get ill, so that you have yourself covered. And that's basic financial risk management that I as an accountant certainly do, but obviously everyone else probably should be doing that if you're not already doing that. And I know lots of people already have emergency funds in place. So you've done your due diligence, you've put your emergency funds in place, you've calculated and worked out how much money would I need to survive for 6 to 9 months, maybe 12 months. Great, you're covered from that perspective. You should put that really in a bank account or a savings account where you can easily access that money if you require it. And that's a key concept that's called liquidity. How liquid or how accessible are your savings is the cash and money that you have available. So things like your emergency fund should be in an account that's quite liquid, quite accessible, where you can withdraw and use that money as and when you need it. There are some savings accounts where you cannot access your money for 6 months or 12 months or even 2 years sometimes, and clearly that's not a great place to put your emergency funds, because you won't have access to it. And I have sometimes seen people make that mistake where they say, I do have a lot of savings, but it's in this account, and if I access it I'm going to lose the interest or the savings, or I just simply cannot access it because the contract or the agreement that I have with my bank is that I cannot access those funds for 12 months or 24 months. So you need an easy access account where you have your emergency funds in place. Once you've done that, and by the way, there are also other really simple, basic, cheap and effective risk management that you can do to put in place some protective measures that will give you peace of mind. And people don't really talk about this as much, neither on YouTube nor on TV or even on anywhere else really. I've not heard this discussed as much. But unemployment insurance is a really cheap and effective way to put in place a safeguard for yourself should you ever be made redundant. Typically the insurance company will pay you between 50 and 60, sometimes even up to 70% of what your salary would have been until you find a new job. And sometimes it's quite specific, so they may pay you for up to 2 years or up to 1 year. It depends on the type of insurance you put in place. And they're not very expensive. They're only £5, £6, £10, £15 a month, again, depending on which insurance provider you go with. So also think about actually maybe in addition to an emergency fund, is it worthwhile me investing in a really simple employment insurance? There's also obviously sickness or ill health insurance, which again may be called income protection insurance. There's different names for it used by different providers and insurance companies, but that's another form of insurance where if you get sick or you get ill, your income will be protected. The insurance company will pay you up to 50, 60, 70% sometimes even of the income that you were earning before you got ill or before you lost your job. And that should give you peace of mind. So you know that regardless of what happens in terms of your job or your income or your health, whether you get made redundant, you at least are financially covered for a period of time that allows you to plan, to recover, to recoup, and to strategize and think about your next steps. Okay, so you've got an emergency fund, you've put in place your safeguards, and you've done your basic risk management. Actually, you're already in a really good place compared to a lot of people out there. You can then start to think about investing. And it's up to you to make that decision. And again, this is not financial advice, consult a financial planner. But you might say, actually, I'm comfortable with having 6 months worth of emergency funds. And once I reach that threshold of savings, anything in excess of that, I'm going to start to invest. Now, this is my third point, my number one rule for investing is only ever invest what you are willing to lose. Only invest what you can afford to lose. If you cannot afford to lose that money and you need it for day-to-day living, or you need it in case of an emergency, you should not be investing that money on the stock market, because the value of shares can go up as well as down. The stock market is inherently unpredictable and volatile, and the value of your investments could go down significantly if there's a market downturn, or if there's, for example, a recession, just at the point that you need it. And this is something that people always forget. You cannot predict what the stock market is going to do. You can maybe try to benefit from the long-term trends, but there are very few people who can confidently say they can predict or time the market. You cannot time the market because there are just too many what's called market participants. There are just too many institutional investors, companies, businesses, people, pension funds, and so on, hedge funds. there are too many people, too many market participants for you to be able to predict what the market is going to do and how volatile the stock market is going to be in any given point. So only invest what you can afford to lose, and you have to decide for yourself what that means and what that is. It could be £500, could be £1,000, could be £5,000, could be £10,000. Only invest what you can afford to lose, and think about what that looks like for you. Okay, so the next thing you then want to do is you've set your investment objectives, you've got an emergency fund in place, you have decided what can I actually afford to invest, and if I were to lose that, if my share values were to go down, I wouldn't be so impacted immediately by that. The next thing you want to do is decide what your investment platform or investment provider is going to be, and to open what's known as a brokerage account. So let's talk about the different types of providers that you can use, or investment platforms, or even apps. You know, there's lots of apps out there as well that you can use to begin to invest today. So the way it works is, for you as you'll be what's known as a retail investor. You're a member of the public who's participating in and investing in the stock market. So you're a retail investor. Retail investors can access the stock market in a few different ways. Number one, you can access the stock market via your bank. Most banks, whether you're with HSBC, NatWest, Barclays and so on, most of your banks will provide share dealing services. And share dealing services is just a fancy way of saying they will help you and allow you to buy and sell shares in the stock market, and you have to go and speak to your bank to find out, or maybe go on their website and find out what are their share dealing services. That's one way and one option of accessing the stock market. I will just give you a caveat though. Banks tend to be traditionally quite an expensive way to access the stock market, and the fees and charges they will charge you typically tend to be a little bit more. So I've explained how you can use banks to buy your shares. I just want to explain now how you can use those other investment platforms and brokers to buy your shares as well. So the way it works is essentially there's a few different ways of doing it. Most of the investment platforms traditionally were called brokers, and they provide brokerage services, which basically just means they can buy and sell and act as a broker to buy and sell investments for you. And investments could then be in different types of investments. Could be into shares, could be into bonds, it could be electronically traded funds, it could be index funds, and so on. And I'll cover what all of those things are in a different video. Today, because everything's being digitalized, most of the investment platforms or brokers have their own app and website typically. So you've then got a choice of whether you use and download the app, and typically they'll have an Android version of the app, and they'll have an iOS Apple version of the app, and therefore you can get those apps either on Play Store or on the Apple universe, where obviously you can either have the app on your laptop or on your mobile phone. So there are lots of different brokers out there and investment platforms. Okay, so I've mentioned some of them: Robinhood, eToro, Trading 212, Freetrade. Not all of those will be available in the UK or in the country that you are in. It depends on your specific regulator and which ones of those have been given the right to act as a broker in your country. But in the UK, I think most of those, except maybe eToro and Robinhood, do operate. So Freetrade, Trading 212, and so on. But leave something in the comments if you've used any of those platforms. What has your experience been like? I'm really interested to hear especially if you've used a few different ones. There are other platforms, more established, more traditional, just as good, and in fact they probably provide more services, but the ones I've just mentioned are known traditionally as what's called execution-only brokers. There are also lots of other investment brokers and investment platforms available. Some of those include Hargreaves Lansdown, Interactive Investor, Vanguard, and they're all really good because they provide also, in addition to share dealing or in addition to execution only services, which is the buying and selling of shares or allowing you to buy and sell shares, what they also do is provide lots of other services, investment research. They potentially may even provide investment advice. So they are much more end-to-end service providers around wealth management, wealth planning, and so on. So it really depends on what level of access you need and what you need from your perspective, what you're trying to achieve and what you're trying to do, and how much you're willing to spend as well, because the services they provide are not free, right? So it depends on how much you're willing to spend. So what I would suggest is just do some research, Google different what investment platforms are available, for example, or what investment brokers are available in the UK, in the US, Australia, New Zealand, you know, wherever you may be at present. So do your own research, do your own due diligence. None of this is financial advice because I don't know your personal circumstances, where you are and so on. So there you go. Hopefully that's been useful. That's a bit of a crash course in how do you even go about buying and buying stocks and shares, accessing the stock market. We've talked about actually have a really clear investment strategy, put aside an emergency fund, think about ways that you can manage your risks around your income, for example, employment insurance, sickness or ill health insurance, redundancy insurance and so on, whether you can put some of those things in place. Then we talked about how do you actually buy stocks and shares, whether it's through your bank, whether it's through an execution-only broker, one of the online platforms that we discussed, or whether it's through one of the more traditional investment brokers. There are lots of other ways to get involved in the stock market, but I just wanted to keep it as simple as possible. Hopefully that's been useful. This is Money Talks with Hamza. Subscribe, like, share this video, and see you guys on the next one.